All right, good morning, everybody. That took a little bit longer than normal. Something up with the Zoom. It suddenly couldn't remember where my microphone was. I don't know about Zoom sometimes. Anyways. Good morning. So, as we can see, a little bit of a mixed bag going on around the world. Some in the red, some in the green. Japan is with us. And if you notice, us is the only ones that are in the green. Everything else is red. It's like a progression, right? It starts with Australia, then we get Asia, then we get Europe, and then our markets come online, kind of like in that order. So things can start out negative around the world, and then slowly those markets close, new markets open, things improve. We're now in the green, not by much, and we're coming up off of that bottom. It's easy to believe that if these other markets had stayed open, that they'd likely have worked their way up into the green. Now, having said that, just like when our markets are closed, we still have futures that move in our markets. It's the same thing with these markets. But news and everything else, and who's participating, a little bit of a mix. It's a quiet day in what is expected to be, a reasonably quiet week, right? All things considered. We do have a lot of Fed speakers today. We got a lot of auctions this week. So we got Harker, Bowman, and 3 and 6 month auctions, and then Bank of England, this pill speech. And really, I mean, that's going to wrap us up. Consumer credit change, you can see how it's a low anticipated impact, 1500 today. And that's it. What you want to keep your eye on is tonight with Japan. If you're not used to these morning briefings yet and my focus on Japan, yeah, you'll come around to it. Just, if you're jumping through the news and you catch anything on Japan, stop and work your way past the headline, see what it is that they're talking about. Right now, Japan has the highest level of threat to shock or surprise the market. And that's the one that really moves markets, right? Is when the market is off sides, is on the wrong side, gets caught by surprise. That's when we can really move. And they have the biggest unknown. So it's worth, keeping your eye on them. There's been a lot of talk with the S&P and the NASDAQ, are we done? Are we not? There was this great tweet out on the weekend by Disruptor. Historically, August and September is a window of weakness for the stock market. Keep that in mind when you predict where the market goes next. You are here, right? We're in that kind of weakness. Now, seasonality just gets you so far, right? It's not a crystal ball or anything like that. But we were all anticipating the pullback. We were all anticipated a topping pattern and that pullback, and that's what we got. So, true, earnings have been great, but the market is priced exactly where it should be. So it's kind of hard to see how we go up, but it's kind of hard to see why we would go down, right? We need a catalyst, I guess is what I was trying to say. We need a reason to go up or a reason to go down. And right now we don't have a reason to go down other than the whole bond situation. We're looking at crude here. It came up into that topping pattern last week. I am on a weekly chart on crude. So it's this nice zone, this area that we've been to before. Now, however you want to mark that top doesn't really matter, right? What matters is we've based down here long enough that we're now over the 50-period weekly moving average, and we're over the 10, the 20, the 200. So, and even the 4. If we were using like old school moving average analysis, then we have surge, with momentum, in trend, with strength. 1, 2, 3, 4. We have all of that. So at this point, we need to see how we interact with the 4-period weekly moving average. And just keep in mind, we are extended past the 10 weekly moving average by quite a bit, right? So one thing that it needs to do, absolutely without doubt, is stay above that 50-week moving average. We've been above it before, right? Last year, October and November, and then again this year, we wicked above it back in April. So it needs to prove it. And then, we could see maybe 92, not in 1 week, but you got to understand the ramifications of the higher energy costs and how that is going to affect the Fed's battle with inflation. It's back. Inflation is like this imaginary beast that you just can't kill, right? Once it comes to life. Yeah, anyways. So keep your eye on energy, US oil. US dollar China is still holding underneath that 145 weekly level. So now we've got a range or a zone. It's pretty solid. Looking at all the major moving averages, it's also still bullish. It doesn't matter that we, are holding underneath that 145 as long as we're still holding above that 138. We've got the 4, the 10, the 20, the 50, the 200, and we're above all of it. So until that changes, we're still bullish. Right now, you could look at it as bullish, but in a range, right? And so it's not a trigger to go short or a trigger to go long until it breaks above or breaks below. This has a direct impact on the 10-year, and the 10-year has a direct impact on the S&P. So if you're asking, why are we looking at US dollar Japan? Who cares? I want to trade the ES. Yeah, I get it. I get it. You'll care when the ES goes down. So this morning, the volume sitting at 106. This is cumulative overnight volume. One day, one period of time, it wouldn't mean anything to anybody. But what we're doing is looking at it consistently, consecutively, day after day, week after week, month after month. We look at this thing every day to try to get a gauge for the overnight trading activity. Now, the way this thing is set up is it starts in the new day. So it's not getting the after hours volume or anything like that. It starts, say, this is Monday, and it started at Monday at midnight and started counting from that. Cumulative implies that it's just adding up what new volume we had to the bar that we had just had, right? So if the first bar was 50 and the second bar was 200, we now have 250. And then the third bar is another 200. We add that to it, right? Cumulative. So that's what we have here. The average or the norm is somewhere around 100. The reason we look at this is if the market is shy about something, if they're waiting on a bit of data, they'll sit out. Most of the time we know what that data is. It's on the economic calendar. But there's times where we don't know that there's something coming out, right? And yet the market will know. The market will sit out. The volume will be really light, and it gets our attention and forces us to go look for why are they sitting out? Why are they not participating? Maybe we find it, maybe we don't. But at the very least, we can sit out. We can, prepare for some shock and awe, because whatever's spooking investors and traders and keeping them out of the market that morning very likely is something that we want to stay out as well until we find what's going on. It often also leads us to find the market maker move, or the MMM, before there even is one, right? Because we know where it comes from. You can see the little bubble on my screen, 10 daily moving average. It's just like what it sounds. It is the 10-period moving average on a daily time frame put on the intraday chart. We bagged into it Friday, failed to keep it, and now we're still holding underneath it. We're also underneath the weekly pivot point, which puts us in a bearish stance right off the bat. and we don't have an MDP because we've already hit it. One positive note we can talk about this morning is that we're at least holding above the weekly low. That's not saying much. So speaking of the weekly, bring it up here for a moment. This is a weekly chart. I've marked 50% of the last week's range. It's 45, 57, and 3 ticks. We're a long ways away from the 50% mark. And we still have the big 50% candle marked below us, which, you know, as time goes by through the day, we might see this 10 tick up a little bit. Just remember that this is a weekly chart. So we're holding inside of this really big candle. And one of the reasons we marked that 50% on that last candle is markets don't want to fall in a straight line, right? They want to maybe run up, get a little momentum to break through that level. Now, we don't know it's going to play out that way, right? Well, we'll see. It needs to get through that 45.57 and close above it. Otherwise, this is a really nice topping pattern for a move lower. Just to, you know, kind of help you keep things in focus. When we were in this situation, we had that really amazing 5-week run and that big, massive gap up. And then we had that red week. And everybody was talking about, that's it, baby, we're going down. It's over. Yep. No. Okay. So just, you know, a little bit of moderation. Okay. 10-day, 30-minute volume profile. When we're at the lows, we go to the highs. When we're at the highs, we expect to go to the lows. We were at the highs and now we are at the lows. We still have a gap that needs to be filled from last week. It's actually an intra-week gap. It's not a Friday to Sunday gap. You could consider that the day that everything changed, right? We're still building into a new classic profile of a B shape. We don't quite have it yet, but we're working on it. So we've got, you know, the very large upper portion. We need a little more down here for a more classic B. If we can get back above 45.50, it's a relatively shallow area. Should be able to move through that, you know, I don't really like the word easy, but with less resistance than, you know, this thing getting there. 45.42 is going to be hard work. There's a lot of trades that happen to there. You got to assume that there's unfinished business there, right? We can see also that we've spent a lot of time there, and it's very likely that if we go back into that area, we're going to spend quite a bit more time, that we won't move through it fast, right? It's an interesting amount of volume. Let's just check that out. Okay, never mind. All right, so what we have this morning are the EV markets, China ADRs, and semiconductors. Oh, and the FANGs and pot stock. So that's a pretty good selection of what's up this morning. Bonds are still down. That's not good. And everything else is flat or negative, flat and positive. Even nat gas, okay, that's not good. We don't want nat gas really leading the way, but set nat gas aside. We do got the FANGs and we do have semiconductors and the China ADRs. So, that's a pretty good mix for a bullish day. It just would have to stick, right? That's kind of the number one selling point. So we can see here that they tried to bring those bonds up on Friday and they're losing it already, right? After all that work, they're already losing it. It ain't sticking. And we can see the dollar is picking back up again after that very swift, significant move to the downside on Friday. They're already bidding it back up again. And the 10-year also that beat down, and they're trying to bring it back up again. So these are going to be the things that you're really going to want to keep your eye on today as you're trying to trade within the markets. Keep in mind that 80% of the market is going to do whatever the S&P is doing, right? So if the S&P is range bound, so is going to be most of the market. Having said that, Friday was a really good range, right? From 45 flat all the way up to 45.62. So a good wide 62-point range. Generally, what we say is if we're inside the previous day's price, it's likely to be a choppy, nasty sideways day. And that usually holds true when the previous day was also a sideways, choppy, nasty day. But Friday wasn't that, right? Friday had a beautiful expansion, and it's actually a classic megaphone shape that finally broke down, right? It just kept getting wider and wider and wider, and then it finally broke to the downside. So I love it when a pattern plays out, right? But now here we are. So while we would normally say if we're inside the previous day's range, it's likely to be choppy, I don't think that really holds true on today. Instead, keep it a little more dialed in. If we're inside of our own Globex price action and yesterday's low, then it's likely to be a choppy, nasty, sideways, difficult trading day. But if we can get out of that zone, then it's game on, right? So we just need to get out of that zone. There is a head and shoulders pattern forming, but it's not where it should be, right? So just to kind of put it in context, a head and shoulders is a reversal pattern, preferably a topping reversal pattern. You shouldn't find it in the lows of a zone or in the lows of a range. Doesn't mean that it can't be there. It just shouldn't be there. So you want to take it with a grain of salt, right? Like really approach with caution. And it should make sense that we're going to find patterns where they don't belong. And that doesn't mean that it won't work, just that it's more likely to fail than if it was found where it's supposed to be. we are really close to VWAP, both in the NASDAQ and in the S&P, but we're underneath it. So, you know, that carries its own weight right there. Everything that we have says we're bearish, right? We're underneath the 10-week. We're underneath the weekly pivot point. We're underneath the VWAP. Until something changes, we're bearish. But if you're struggling, right, which is what the whole idea is here, if you're losing more often than you win and you're struggling to be, consistently profitable, stop doing the hard stuff. And the hard stuff would be trading in a zone or a range that maybe doesn't give you enough room for the size of your stop, maybe, right there. This was something we talked about quite a bit last week with Tuesday and Wednesday, or maybe it was Wednesday and Thursday. Yeah, Wednesday, Thursday. These zones and ranges, that's some pretty nasty stuff. It's not to say that you can't do it, just that if you're struggling, don't do it. So I got a pretty good feeling about this range for the day, that this is it, right? If we stay inside this range, you're going to have a hard time trading. If we get out of this range, then maybe it gets better. But you'll notice when we get through the top of that, then we're right into all this trash, right? We're right into the thick of it from Thursday and Friday. So you could say that until we get through the top, it's going to be pretty nasty. And that the easier road would be to the downside. So the EVs are looking the best. The China ADR is right behind it. They're going to be kind of doing their own thing, right? When you look at those compared to what the S&P and the NASDAQ looks like, they're their own chart, right? They don't look like they play well with others. So they're not going to be so heavily influenced like the S&P and the NASDAQ. But having said that, if a rising tide lifts all boats and, a falling tide drops all boats, then even having said that it's not going to directly correlate with the S&P and the NASDAQ, if the entirety of the market is going down, these aren't going to go up that well, and very likely are going to go down. They are still continuing to improve, right? We've got the 10-20 cross. We got above the 50 and it's still just trying to prove it. We got a little extended last week from the 10-period moving average. So you gotta, kind of have anticipated that we were going to pull back a little bit. The only thing of concern or of note this morning are the financials. So we kind of need those. KRE is not looking that hot so far this morning. If we look at how the financials are doing in the little homemade ETF that I made, they're really down, right? So it shows in the last, say, in the last 5 days, financials are down 1.67%, and this morning they're just up not even 0.25%. Our benchmark is 0.5%. %14 of the S&P is up 0.5%. That's a very minor, negligible amount. And 26% of the NASDAQ is up 0.5%. Now we know that there's no financials in the NASDAQ 100, and we just looked at the S&P 100 versus the NASDAQ 100. The NASDAQ's got way more names up. So, it stands to reason this morning finance isn't doing good, but tech and junior tech is doing good. That's going to be the key turnaround point for today. Can we rally and get like a crazy bullish rip to the upside? If we can get financials in the game, we can, right? Tech can do it, right? Don't get me wrong. Tech can do it all by itself. But when you have the top 3 sectors working together, consumer discretionary, tech, and finance, those are the days when we can really rip it. On the other hand, if finance is already weak and we start to lose tech, then we could really have one of those down days like we had last week, a couple of those good ones, right? Another 2% to the downside. The financials should tie in with the 10-year with everything that's going on with bonds and treasury. So it's not like, you got to really stick your neck out there. And that's short, sweet, and to the point here. You've got some of your biggest major markets up this morning with the FANG names, mega market cap, semiconductors. You got the China ADRs, pot stocks, so a little bit of flavor from the dash for trash short squeeze plays. A little something for everybody. Just keep your eye on energy topping out, and the 10-year with the dollar in case it starts to flip around and go back up again. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.